the great thing about corporate governance improvement, shareholder, value maximization, is it's non-GDP, predicated, right? And so if you've got a global economy that's okay outside the U.S. but not great, other than India and the U.S., most economic climate isn't around the world isn't the greatest. So in Japan, you've got things that are improving, capital allocations improving, margins are improving slowly but surely over time. It's glacial, but it's persistent. And so, I look at this information, I look at the news for, Seven and I and the tender offer there from Couche-Tard to the Canadian convenience store operator, and now the management buyout offer from the Ito family. And the offer price just keeps increasing. That's fantastic. That's what we as international investors want to see in places like Japan. Seven and I just looked up the old research file. Last time I really did a deep dive was 2017. We took a pass because return on assets were deplorable, and they've been pretty bad ever since. They've done a few good things, but overall, this is a business that's really not improving its capital allocation over time. And so what's already happened with this Couche-Tard offer? Well, you've got a rationalization of the business units. You're talking about potential IPO of the U.S. Convenience store, jettisoning some of the also ran domestic retail and supermarket operations in Japan. And the crown jewel is really the 7-Eleven franchise in Japan. So that's great if we can get that isolated and valued correctly in the marketplace. And those are the type of opportunities that, we want to find. And Sony's another one.
Yeah, talk about Sony. It's been a while when anybody's recommended Sony. Of course, given its PlayStation and games business, gaming console, obviously it has a supreme position in the market. But still, walk us through the rationale here and how much upside do you see for this one?
You're right, Tanvir. This is the forgotten multinational. It's a great company because, again, corporate governance story du jour here is that 15 years ago, their ROEs were flat to negative, and they're now been 15, 16%. Why? They sold the computer division. They got out of chemicals. They got out of materials. They doubled down on music streaming, image sensors for the smartphone cameras, and obviously the game station. And so what is the catalyst now? Well, you had a 2022 post-pandemic hangover on the gaming units, right? People started looking outside and enjoying the sun again. And so now you're starting to get growth off of that reset lower base in the gaming division that's structurally advantaged because margins are improving as it gets to more recurring, more subscription volumes to the PlayStation Plus network, more monetization of the gaming's in-game purchases. They take a 30% cut of everything that's sold across the platform, on just like, the Apple Store or the Google Store. So it's a great business. It's a great franchise. Music streaming is a 10% growth annuity. And so that stuff's not valued correctly. The whole thing on a sum of the parts basis is 9 times EV to EBITDA, about 16, 17 times PE, versus tech stocks in the US trading at 30. And this is a business that, we have a 25% plus price target upside. And, guidance from management is for 10% plus the next 3 years. So this is a business, unlike Seven and I, that's already been rationalized. It's growing nicely. It did suffer a post-pandemic hangover, but we looked for that to be growing out of it the next 3 years.